Hello and welcome to Chapter 18. We're going to talk about mergers, divestitures, business failures, leverage buyouts. So we want to understand in this chapter the fundamentals of mergers and acquisitions, including the basic terminology, motivations for merging companies, and different types of mergers. We want to look at the objectives and procedures for LBOs, leverage buyouts, and divestitures. We're going to demonstrate procedures to value target companies and discuss the effect of a stop swap transactions on earnings per share of a company. We're going to look to talk about the merger negotiation process, what a holding company is, what are special circumstances or risks in an international merger. We're going to understand the major causes of business failure. We're going to look at voluntary settlements to sustain or liquidate a failed firm. This is very interesting. Why do companies fail, and what's the most common reasons? We're going to be talking about that. We're going to talk about bankruptcy in the corporate sense and the procedures involved for reorganizing and liquidating a bankrupt firm. Okay, so let's talk about some basic merger fundamentals. Terminology. Okay, so the first term you may hear quite often is corporate restructuring. So what is corporate restructuring? Well, it's really any activities where a company is going to expand or a contraction of the firm's operations. So any major change in ownership of assets, any major financial ownership structure change, anywhere where the basic core of the company is changing, mostly related to financial terms, would be a corporate restructuring. So companies that are having problems competing or problems surviving in the current environment may look to restructure to realign themselves to a more profitable organizational format. Now, a merger is a combination of two or more companies, which results in a firm maintaining the identity of one of the firms, usually the larger. So in a merger, for the most part, the larger, bigger company would maintain its identity and absorb a smaller company. And consolidation is a combination of two or more firms that develop a completely new corporation. So this is quite often when two relatively similar sized companies come together, they may form a new company altogether in the consolidation. Okay, a holding company. So this is a term used a lot, and this is basically a corporation that has voting control over one or more other corporations. So a holding company has the voting rights, and that holding company may hold 6 or 7 different companies together and control the voting rights of that company, basically control the set of companies. Subsidiaries are companies that are controlled by a holding company. So if you look inside a holding company, you'll see several subsidiaries. The acquiring company is the firm in the merger transaction that attempts to acquire or take control of another firm. The target company is the firm in the merger transaction that's being acquired or being pursued. So you have two basic types of mergers. You have a friendly merger and a hostile merger. So a friendly merger is a merger endorsed by both companies, and the target firm, of course, is an agreement and approved by its stockholders, and it's easily consummated. In a hostile merger, the transaction of the target firm, the management does not support the acquisition, and the acquiring company is going to force itself on to gain control of the firm by buying shares in the marketplace. So if the hostile company can get enough shares to control enough votes, then they can force the merger to occur. Now, there are some mergers that are strategic, and it's in nature to achieve certain economic goals or to obtain certain parts of a business. So maybe your strategic plan is to be more vertically integrated, so you merge with companies at different levels in the business chain. A financial merger is a transaction where two companies are going to the goal of restructuring, acquiring another company to improve its cash flow, unlock unrealized value or tax benefits or synergies that will help the company perform better financially. So what are the motivations for a merger? There are many motivations for a merger, and I guess the overriding idea or concept or goal is to maximize the owner's wealth. So by two companies coming together, if they can uh, maximize the value of the two, if the one company as together as a whole is more valuable than the two separate companies, then that's what the merger's goal is trying to achieve, and usually through synergy, which means that by coming together, say you have two companies like Coca-Cola and Vitamin Water. Vitamin Water is being acquired by Coca-Cola. Now, Vitamin Water can double, triple, or quadruple their sales because they have access to Coca-Cola's distribution markets. So that would be an effect of a synergy where the cost of acquiring a company is well worth it. For example, when Pepsi acquired Gatorade, it paid billions of dollars for Gatorade, but knew that it was getting a number one brand in the sports drink area, and they're going to be able to enhance the sales of Gatorade by putting it through Pepsi's many distribution channels. Okay, so more specific motives, of course, include growth and diversification, synergy, which I just talked about, fundraising, increasing managerial skill or technology. So if you have one company that's behind in technology, so maybe you have a graphics design, video graphics design company that's falling behind technology. They acquire another company that has the technology or skills. Tax consideration, if they're trying to get, some companies may hold a huge tax loss that could be beneficial for a company that has to pay a lot of money in taxes. Increased ownership liquidity, helping, making the company bigger, giving the ownership, make it more liquid to sell their shares. And defense against a takeover. So if there's another takeover and your company engages in a merger and acquisition, your company may become less desirable for another company's hostile takeover. So those are some of the primary motivations for merging. Now there are some limits on how big a company can get, mostly related to competition. So if you're doing proposed acquisitions and you're reducing the competition to the point where you're a monopoly, then you're going to get a knock on your door from the FTC, the Federal Trade Commission, and the Justice Department, which is going to look into or break up companies or deny mergers or acquisitions of companies that are gaining too much competitive power and eliminating too many competitors. And this is a big problem for Microsoft, but for both the European Union and the United States in their domination of the browser market in the late 1990s. Okay, so when we talked earlier about different motives for merging, one was about tax. So if a company has a large tax loss carry forward, that means that the company had a lot of losses in previous years. That tax loss, even though the company itself can't utilize it because they have no profits, in a merger, the company acquiring the firm with the tax loss can use that tax loss to be applied against their future income, thereby lowering their future taxes. So there is value in companies that have a certain amount of money in tax losses beyond the value of the business itself. The value of the tax loss may be a powerful incentive for a company to merge. So a company with a tax loss could acquire a profitable company to utilize its tax loss, or a profitable company can acquire a company with a tax loss. And tax loss may also be useful depending on the industry, and there could be other certain tax benefits tied to it. Okay, so let's look at total taxes and after-tax earnings for Hudson Company without and with the merger. So we're going to look at this example. So the Bergen Company is a wheel manufacturer, has a total of $450,000 in tax loss carryforwards. To use these losses and diversify its operation, Hudson Company, a manufacturer of plastics, has acquired Bergen through a merger. Hudson expects to have before-tax earnings of $300,000 this year. So in Table 18.1, total taxes and after-tax earnings for Hudson Company without the merger, we see that we have, for 3 years, we have earnings per share of $300,000, or a total of $900,000. And we have the taxes at a 40% rate, so we have the earnings after taxes. Now, if we look at the total taxes and after-tax earnings with the merger, we see that we can use the tax loss carry forward for year one, eliminating all profits and taxes from year one, and in year which gives us the total earnings of 300,000 since there's no tax consequences. And in year two, the remaining $150,000, which lowers our taxes from 120 to 60, bringing our total income earnings after taxes 240. So our actual earnings go up from 540,000 to 720,000. So that is a let's see, $180,000 difference. And what that means is if the purchase of the other company is less than 180,000, then that would be a beneficial merger just on the tax basis alone. So let's look at other merger fundamentals, different types of merger. So we have a horizontal merger, and this is a merger where two firms in the same line of business at the same level merge. So it could be two retailers like American Eagle Outfitters and H&M can do a horizontal merger together because they're both fashion retailers. In a vertical merger is a merger where an acquiring firm acquires a supplier. So it could be something where H&M acquires a clothing manufacturer. Now, a congenic merger is a merger where one firm acquires another firm in the same general industry, but neither in the same exact line of business. So it's neither supplier or customer. So in addition, a conglomerate merger is a merger combining firms in unrelated industries or businesses. So let's talk about leverage buyout, sometimes known as LBO. So a leverage buyout is an acquisition involving use of a large amount of debt to purchase a firm. And it's an example of a financial merger. So we've had leverage buyouts of big companies like Dunkin' Donuts and Burger King in the past, where creditors put a lot of money together to buy the company, rehabilitate it, and then sell the company at a profit, or bring the company public and keeping a profit for themselves after going public. So what makes an attractive candidate for acquisition in a leverage buyout? They should possess three of these characteristics. One, it must have a good position in the industry with solid profit history and reasonable expectations of growth. One of the reasons that the leverage buyout of Dunkin' Donuts was so popular is because Dunkin' Donuts had yet to expand its locations into the entire United States and into the entire world. So it had a lot of growth potential in expanding of its stores across the world. And it was also a very profitable company, as any company that sells a lot of coffee is. Two, the firm should have relatively low levels of debt and a high level of bankable assets that can be used as a collateral for the loan. So again, the brand Dunkin' Donuts is a huge asset because the brand is well known, and that was the collateral for the loan that eventually purchased Dunkin' Donuts from private owners. And then that company was later restructured and reissued as a public company, making the management team that put together the leverage buyout very wealthy based on that one transaction. Number three, it also must have a stable and predictable cash flow that is adequate to meet the interest and principal needs on the debt and provide adequate working capital. So again, Dunkin' Donuts had a reliable stream of revenue from its stores and its franchisees that could easily pay back the interest and principal on the loan, but yet provide enough working capital that they continue their expansion and aggressive advertising campaigns. Okay, so what is an operating unit? So it's part of a business such as a plant, a division, a product line, or a subsidy. So it contributes to the operations of the firm, and it's just a separate operating unit that has its own structure. Now, a divestiture is selling one of the firm's assets for various strategic reasons. So a divestiture can occur in selling of an operating unit or a product line or a division of the company. So, and this is quite common for a lot of companies to say, okay, this is no longer our core business, or this is slowing us up, or we're not interested in this. Let's spin it off to its own company or to another company to purchase. So here's a personal example. Um, um, so Lena and Gino have two children, ages 2 and 4. They're in the process of analyzing if it makes sense, economic sense, to hire childcare and have Elena return to work as a credit analyst. They estimated that she can earn $5,800 per month gross, and her employer's 401k, including her employer's 401k contributions. In addition, she expects to receive monthly employer-paid benefits that include health insurance, life insurance, and pension contributions totaling $1,800. She expects her federal and state tax income to be about $1,900 per month, and they estimate the total additional expenses, childcare, clothing, personal expenses, meals away from home, and transportation related to the job to be about $1,500 per month. So if we look at this additional gross plus her employee benefits, gives her additional income of $7,600. And if we look at the additional taxes and additional expenses, that the additional taxes and expenses together is $3,400. Subtract that from the $7,600, we get an additional net income of $4,200. So because their income will increase by $4,200, they should definitely have Elena divest herself of her child care responsibilities and return to work. Okay, so a firm divests itself of operating units by a variety of different methods. One involves the sale of a product line from one firm to another. So if it's a particular product line that no longer fits your needs, you can sell it to a different company who has more of a strategic interest in taking over that product line. A second method that has become popular is the sale of a unit from existing management. And the sale is often achieved through the use of a leveraged buyout. So they basically see there's an existing unit in the business that they're going to actually sell to the management. So the management's going to put together a leveraged buyout package, buy that unit, and operate it as their own company. Also, sometimes when you have a divestiture, it could be considered a spin-off. So a spin-off occurs when one large company is spinning off a separate division or piece of their company into a separate company. And so the operating unit becomes independent, fully independent, and the issuance of shares on top of it in the pro forma basis to the parent company shareholders. So you can actually, if you're a public company, you could spin off part of your company as another public company and retain shares in that company. And that's a way of being a divestiture, which is sort of like a reverse merger. And the final and least popular way involves liquidation of a unit's individual assets. So if you just figure out that, okay, we have this VCR manufacturing division, there's really no longer any demands for VCRs. Let's lay off all the people, sell the real estate buildings, and try to sell as much of the equipment, machinery, and inventory as we can, and liquidate and end the business. And it's not popular because it's really, giving up totally and just trying to. You don't do this for a business that's completely defunct. So regardless of whatever method a company uses to rid themselves of an unwanted operating unit, the goal is primarily to create a more lean and focused operation, enhance the efficiency, enhance the profitability, enhance the expertise, and create a maximized value for shareholders. So if you have a company with a really hot, 50% of the company is a really hot up and coming growth division, and the other 50% is stuck in a slow growing, slow profit area, it makes sense to break the two companies up into two different companies so the very fast growth company can achieve a much higher stock price and valuation for its investors, and the slower growth company can pursue a more dividend income oriented model. So the comparison of post-divestitures and pre-divestitures market value have shown that the breakup value, or the value of the firm measured by the sum of the values of its operating units, if each were sold separately, of many firms is significantly greater than the combined value. And it makes sense because you would only break up if you saw there's a value in breaking up the company rather than staying together. So if we look at the negotiating mergers and valuing the target company, so if you're making acquisition of assets, if assets is the reason you're buying this company, so it's not the income earning potential of business, but the actual assets of the company. So it's a general fixed assets value that the acquiring company would need. So the price being paid for the acquisition depends largely on, the value of those assets being acquired. And it also must be considered to any tax losses that the company could provide. So if the company it could be a company that's failing and has a lot of losses, but yet has some machinery and equipment or land that's valuable. The acquisition could just be to acquire that land and tax loss and equipment. So to determine whether the purchase of assets is financially justified, the acquirer must estimate both the costs and the benefit of the target assets. So let's look at Clark Company. Is interested in acquiring certain fixed assets of Noble Company. So Noble has a tax loss carry forward from losses over 5 years and is interested in selling out. Yet, but its wishes to sell out entirely, not just to get rid of a certain fixed asset. So it wants to sell the whole business. So if we look at the company's balance sheet, we see the cash, accounts receivable, inventories for machine A, value of machine A, B, and C, and land and building. So the total assets are 200,000, and the liabilities, we have 80,000 liabilities and 120,000 in stockholders' equity. So it needs only to sell. So Clark Company only needs only machines B and C and the land and the buildings. However, it has made some inquiries and arranged to sell the accounts receivable, the inventories, and machine A for 23,000 because it doesn't need any of that. Because there is also 2,000 in cash, Clark will get 25,000 for the excess assets. So Noble wants $100,000 for the entire company, which means that Clark will pay the firm's creditors the $80,000 that they owe, and that's from, if we look back up here, this is what they're talking about, the liabilities. They have to, if they acquire the company, they're going to have to pay those liabilities. And its owners, 20,000. So the actual outlay of Clark after liquidating the unneeded assets will be 75,000, or 80,000 plus the 20,000, $80,000 of liabilities, $20,000 to the owners, minus the $20,000 to owners, minus the $25,000 of receiving in excess assets means the purchase price for machine A, machine B, and the land and building would be 75,000. So let's look at the net present value of Noble Company's assets. So net present value is an important consideration in mergers and acquisitions when we're looking at cash flows. So the after-tax cash inflows that are expected to result from the new assets and the applicable tax losses are $14,000 per year for the next 5 years and $12,000 per year for the following 5 years after that. So the desirability of the asset acquisition can be determined by calculating the net present value of this cash outlay using Clark Company's weighted average cost of capital of 11%. So here we have the cash flows from years 1 through 5 at 14,000. We can do a present value of that annuity and make that the actual value be 51,000, and then we'll do a present value of years 6 through 10 of the 12,000, noting that the present value of the 12,000 becomes less as we move forward in time. So if we add up all of the present values of these cash flows, we get a present value of the cash inflows of 78,000 minus the 75,000 cash to acquire. After 10 years of owning these assets, we would have a net present value of 3,000, which would make the merger profitable. Okay, so let's look at acquisitions of going concerns. So analyzing and using capital budgeting techniques that we learned from previous chapters, this is similar to those used for asset allocation. So we could use these capital budgeting techniques for asset allocations and acquisitions. So this method of estimating expected cash flows from acquisition are similar to those used in estimating cash flows from budgeting cash flows, from the capital budgeting cash flows. So typically, pro forma income statements reflect the post-merger revenues and the costs attributed to the target company as are prepared. So they have then adjusted to reflect the cash flows over a relevant time period. So let's look at this example to explain this better. Okay, so Square Company is thinking about acquiring Circle Company for $60,000. Square currently has a high degree of financial leverage, which is reflected in its 13% cost of capital. Because of the low financial leverage of Circle Company, Square estimates that its overall cost of capital will be dropped to 10% after the acquisition. Because the effect is less risky, uh, the capital structure will be less risky, cannot be reflected in the expected cash flows. The post-merger cost of capital 10% must be used to evaluate the cash flows that are expected from the acquisition. So the post-merger cash flows attributed to the target company are forecasted over a 30-year time horizon. So if we look at that, we could see that the first 10 years cash flow inflow is $5,000, which gives us a present value of $30,000. The next from year 11 to 18 is $13,000 per year, which gives us a present value of $26,000, discounted at 10%. And year 19 for 30 is $4,000 of cash flows estimated, which gives us a present value of only $4,900. So the total present value of cash flows are $62,000. We take away the cash purchase price of $60,000, and we get a net present value of $2,364, which means that this acquisition would be profitable. Now, if we're analyzing a merger utilizing a stop-swap transaction, then what we're basically doing is if the acquiring company is going to go to the target company and offer them a ratio of the acquiring company's stock to the target company's stock. So they may say something like, we're going to give you 2 shares of our stock for every 1 share of your stock. So if you had 100 shares in the target company, you now would have 200 shares in the acquiring company. And that 2 to 1 would be called the ratio of an exchange. And this can also be done through stating a dollar amount. So we could translate the stock prices into dollars and calculate the same ratio of exchange. So for example, Grand Company, whose stock is currently selling at $80 per share, is interested in acquiring Small Company. So to prepare for the acquisition, Grand has been purchasing its own shares over the past 3 years, and Small stock is currently selling for $75 per share. But in the merger negotiations, Grand found it necessary to offer Small $110 per share. Small has agreed to accept Grand's stock in exchange for its shares, as stated in the current stock currently selling at $8 per share, and it must pay $110 for Small stock. So if we take the $110 and divide it by the $80, so $80 is the current price of Small shares, but they want to buy it at $110 because you always have to offer more than what's currently trading at to get the shareholders to agree. And once we divide those two numbers, we get an exchange ratio of 1.375. So Grand's company must exchange 1.375 shares of its stock for each stock in company Small. Now, although the cash flows and the value of the primary focus here, it's useful to consider the effects of a proposed merger on the earnings per share. So the accounting returns that are relative to the cash flows and values. Because remember, you will be expanding the amount of outstanding shares once the target company is acquired, because you're going to be putting more shares in the public. So when the ratio exchange is equal to 1, both the acquiring firm and the target company have the same pre-merger earnings per share, and the merging firm's earnings per share will initially remain constant because it's a 1-to-1 ratio. So this is very rare, and both the acquiring firm and the target firm will also have to have equal price to earning and PE ratios, which again is very rare. So and more often, the earnings per share of the merged firms are generally above the pre-merger earnings per share of one of the firms and below the pre-merger earnings per share of the other. So after the necessary adjustment has been made for the ratio of exchange, we're going to see a difference in the earnings per share. So here in this example, Grand Company, going back to Grand and Small Company, they swapped their stock at 1.37 ratio shares of stock for each share of Small Company. So let's look at Grand Company's earnings available to common stock and Small Company. So we have 500,000 and 100,000. Now the number of outstanding shares is 125,000 for grand company, 25,000. I'm sorry, 20,000 for small company. So the earnings per share would be 1 divided by 2. So if we take the 500,000 divided by the 125, we get 4. And here we take the 100,000 divided by 20,000, we get 5. So this is grand company's earnings per share is currently 4, small is currently 5. So we take the market price per share and we can divide the market price 4 by 3, the earnings per share, to get the PE multiple. So $80 is 20 times 4. Okay, so that's where we start. Now, let's look at if they complete the merger and retire 20,000 shares of small company stock that's outstanding, Grand will have to issue or use treasury stock and create 27,500 new shares in the market. And that's the exchange rate of 1.375 times the 20,000 shares it's exchanging. So if the earnings for each of the stock firms remain constant, the merged company would have new earnings of 60,000. So if we take the new merged earnings of 60,000 and we're going to divide that by the new outstanding shares, which is the 125,000 currently outstanding plus the new 27,500 shares created, that's going to give us an earnings per share of $3.93. So if we take that $3.93 and times it by the exchange ratio, it becomes $5.40 utilizing the exchange ratio. Okay. Now let's talk about the post-merger earnings per share for owners of the acquiring and target companies, and it could be explained by comparing the PE or price to earnings ratio paid by the acquiring company with the initial PE ratio. So let's look at the effects of earnings per share. So if the PE ratio, and this is a relationship between the PE ratio paid and the PE ratio of the acquiring company. So if the PE ratio paid is greater than the PE ratio of the acquiring company, the acquiring company's earnings per share will decrease while the target company's earnings per share will increase. Why? Because we're paying above PE level for the target company. If the PE level is equal, if we're paying a PE level price that makes the price to earnings level equal for both companies, then the acquiring company's earnings per share and the target company's earnings per share will be constant. If the price to earnings we pay are less for the target company than the acquiring company, this will increase the acquiring company's earnings per share and decrease the target company's earnings per share. Okay. So Grand Company's PE ratio of 20 and the PE ratio paid for small company earnings per share was 22. We find this by taking the 110 divided by 5, its earnings per share. Because the PE ratio paid for small company was greater than the PE ratio paid for Grand Company, the effect of the merger was to decrease the earnings per share of the holding company, and we see this because we went from $4 to $3.93. If you go back a couple of slides, you can see how we calculated $3.93 here. And the increase in the earnings per share for the original shareholders of small companies goes from 5 to 540. And again, that's detailed back here. And we had able to find the 540 by multiplying the new company's earnings per share by the exchange rate of the stock swap. Okay. So the long run effect of a merger on earnings per share and the share of the merger company depends largely on whether the earnings of the merged firm now grow. So it's hopes that this merger is going to be beneficial and the two companies will have synergy and their earnings will grow faster. So although the initial decrease in the earnings per share of the stock is a disappointment held by the original owners of the acquiring firm, it's expected. And long-term effects of the merger, if it's a smart merger and it's going to produce a bountiful fruit, the earnings per share will be quite favorable in the future. Because firms generally expect growth in earnings, a key factor enabling the acquiring company to experience higher earnings per share than it would without the merger, that is that the earnings attributed to the target company's assets grow more rapidly than those resulting from the acquiring firm's pre-merger assets, meaning that you want to acquire a firm, or the target firm should have a growth rate that's faster than your current growth rate to accelerate growth for the company, because that's what your investors are looking for. They're looking for growth in earnings and growth in revenues, and that's a big motivation for acquiring another company. So we could look here at the earnings per share of with the merger and without the merger. So we see that with the merger, the earnings per share are lower. This is like that 393. But as the years go by, the earnings per share will be higher due to the growth rate of the new company. And without the merger, we'll see that, of course, the current growth rates were higher, $4 versus 393. But without the benefit of the other target company, the earnings per share do not accelerate. And we can see that in the chart here. This is without the merger. Without the merger, we start from 4 and go to 464. But with the merger and the higher growth rate of the combined companies, the ending earnings per share in 2020 will be 472. So this is what shows that the merger is beneficial. And this is based on 3% annual growth, based on 125,000 outstanding shares, and that's a 3% annual growth for the grand company earnings and 7% growth for the small company. Okay. Now, if we want to analyze this ratio of exchange in market price, we can indicate that the market price per share the acquiring firm paid for each dollar the market price per share paid by the target firm. And we could look at this example below, where the MPR, the market price ratio, is going to equal the market price of the acquiring firm times the ratio of exchange divided by the market price of the target firm. So we can see that in this example, where the market price of Grand stock was $80 per share, and the small companies was $75. The ratio of exchange was 1.375. Substituting these variables into the previous yields, a ratio of exchange in the market price, we can get this result, a price of 1.47. So it's the $80 times the 1.37 divided by the 75. And this is, this is based on this formula here. This means that 1.47 of the market price of Grand Company is given in exchange for every dollar of the market price of the small company. So that's another way of quantifying the dollar amount of this transaction. Okay, so at this point, I'm going to end part 1 of chapter 18, and please look for the next video to follow, which will be part 2 of chapter 18. Thank you.